Market crashes are a fact of life for investors. Like earthquakes or hurricanes, we know they will happen. We just don't know when. These sudden and dramatic drops in stock prices can be unsettling. They shake investor confidence and make even seasoned investors question their strategies. But understanding the nature of market crashes and their historical context can help investors navigate these turbulent times. Remember, market crashes are not unique to our time. They have been a recurring feature of financial markets since their inception. From the Dutch tulip mania of the 17th century to the South Sea bubble of the 18th century, history is littered with examples of speculative bubbles that eventually burst. The key takeaway is that market crashes are a natural part of the economic cycle. Understanding this is the first step in managing your anxiety when markets inevitably fall. Don't panic. Instead, view these downturns as opportunities to buy quality companies at discounted prices. The 1929 crash, a defining moment in financial history, saw the Dow Jones Industrial Average plummet nearly 90% from its peak. This crash marked the beginning of the Great Depression, a period of widespread economic hardship that lasted for a decade. The crash was triggered by a combination of factors including excessive speculation, high levels of margin debt, and a weak banking system. Fast forward to the late 1990s, and the dot-com bubble inflated, fueled by irrational exuberance for internet companies. Investors poured money into any company with a .com in its name, regardless of its profitability or even a viable business plan. The bubble burst in 2000, wiping out trillions of dollars in market value and leaving investors with a stark reminder that valuations do matter. The 2008 financial crisis, rooted in the subprime mortgage market, brought the global financial system to the brink of collapse. The crisis highlighted the interconnectedness of global markets and the dangers of excessive leverage and unregulated financial innovation. More recently, the COVID-19 pandemic triggered a market crash in early 2020. The pandemic's unprecedented nature and the uncertainty surrounding its duration and impact on the global economy sparked a wave of panic selling, sending shockwaves through financial markets. These historical examples demonstrate that market crashes, while painful in the short term, are not insurmountable. They also offer valuable lessons about market psychology, the importance of risk management, and the dangers of speculation. While market crashes can be unsettling, it's crucial to remember that they don't spell the end for equity markets. History has shown time and again that markets are resilient. They have an uncanny ability to recover from even the most severe downturns. The key to understanding this resilience lies in the fundamental nature of stock markets. Stock markets are forward-looking. They reflect investors' collective expectations about the future earnings and growth prospects of companies. While crashes are often triggered by short-term shocks or imbalances, they don't necessarily reflect a permanent impairment in the long-term earning power of businesses. Consider this. Despite experiencing numerous crashes, wars, recessions, and pandemics, the U.S. stock market has delivered positive returns over the long run. This long-term upward trend is driven by several factors, including technological innovation, productivity growth, and the enduring human spirit of entrepreneurship and innovation. So, while market crashes are an inevitable part of the investment landscape, they are not a reason to abandon equities altogether. Instead, they should be viewed as opportunities to reassess your investment strategy, rebalance your portfolio, and potentially capitalize on lower prices. Section 4. Tuning out the noise. Focusing on long-term fundamentals. One of the biggest challenges investors face during market crashes is separating short-term noise from long-term fundamentals. Crashes often create a climate of fear and uncertainty, leading to emotional decision-making and a focus on short-term price fluctuations. However, successful investing requires a long-term perspective and a focus on the underlying fundamentals that drive business value. Short-term market movements are often driven by sentiment, speculation, and news flow, which can be highly unpredictable and volatile. Long-term market performance, on the other hand, is driven by more fundamental factors, such as corporate earnings, economic growth, and interest rates. To tune out the noise, investors should focus on the following. Earnings. Pay attention to companies' earnings reports and their guidance for future growth. Look for companies with a track record of consistent profitability and strong earnings growth potential. Valuation. Consider whether a company's stock price is justified by its underlying fundamentals. Look for companies that are undervalued by the market, offering a margin of safety. Balance sheet strength. Examine a company's financial health by looking at its balance sheet. Look for companies with low debt levels and strong cash flows, which provide a buffer during economic downturns. Section 5. Navigating the downturn. Advice for every investor. Market downturns can be challenging for investors of all levels, but they can be particularly daunting for those who are new to the game. Here's some advice tailored to investors at different stages in their investment journey. New investors, start small, think big. Don't feel pressured to invest a large sum of money all at once. Start with a small amount that you're comfortable with, and gradually increase your investments over time. Focus on education. Take advantage of this time to learn about investing and develop a sound investment strategy. Read books, take online courses, and consider working with a financial advisor. Embrace diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes such as stocks, bonds, and real estate to reduce your overall risk. Experienced investors, revisit your risk tolerance. Market downturns are a good time to reassess your risk tolerance. If you find yourself overly anxious about market fluctuations, you may need to adjust your asset allocation to a more conservative approach. Look for opportunities. Market downturns often create opportunities to buy high-quality companies at discounted prices. Consider adding to your positions in companies you believe in for the long term. Tax loss harvesting. Consider selling losing investments to offset capital gains and reduce your tax liability. This can be a valuable strategy for mitigating losses during market downturns. Savvy investors, explore alternative investments. Consider diversifying beyond traditional asset classes by exploring alternative investments such as private equity, venture capital, or real estate. These asset classes can offer unique return profiles and potential diversification benefits. Consider short selling. For experienced investors, short selling can be a strategy to profit from market downturns. However, this strategy is highly risky and should be approached with caution. Maintain a long-term perspective. Remember that market downturns are a natural part of the investment cycle. Don't let short-term fluctuations derail your long-term investment goals. Section 6. Staying calm amidst the chaos. Strategies for success. Staying calm and rational during market crashes can be a challenge, but it's essential for making sound investment decisions. Here are some strategies to help you stay grounded. Tune out the noise. Limit your exposure to financial news and market commentary, which can often exacerbate fear and anxiety. Remember, much of what is reported in the media is short-term noise that has little bearing on long-term market trends. Focus on what you can control. You can't control the market, but you can control your own investment decisions. Focus on what you can control, such as your savings rate, asset allocation, and investment selection. Remember your time horizon. Investing is a long-term game. Unless you need to access your money in the short term, try to look beyond the current market volatility and focus on your long-term financial goals. Have an emergency fund. Make sure you have a comfortable emergency fund in place to cover unexpected expenses. This will provide you with peace of mind and prevent you from having to sell investments at inopportune times. Seek professional advice. Don't be afraid to seek professional financial advice if you're feeling overwhelmed or uncertain about your investment strategy. A qualified financial advisor can provide objective guidance and help you navigate market turmoil. Section 7. Conclusion. The importance of patience and perspective. Market crashes are an inevitable part of the investment journey. They can be unsettling and test the resolve of even the most seasoned investors. However, by understanding the historical context of market crashes, focusing on long-term fundamentals, and maintaining a disciplined investment approach, investors can navigate these turbulent times and emerge stronger on the other side. Remember, investing is a marathon, not a sprint. Patience, discipline, and a long-term perspective are essential ingredients for success. By staying calm, staying invested, and making rational decisions based on your financial goals and risk tolerance, you can weather any market storm and achieve your financial aspirations.